What is going on, everyone? Hope y'all are doing well, and in this video I'm going to share in depth why myself and many economists believe that the real estate market will not crash. As a real estate investor who has made over $200,000 in real estate over the last 4 years and looks at the housing data on a regular basis, I want to share the facts about real estate and not the headlines that many people try to get you to read. But I don't want to waste your time, so let's go ahead and dive right in. So before I start sharing the data about what to expect for the future, it's important to share the data that got us to where we are today. Housing has gone up almost 45% since the beginning of the pandemic in March of 2020. And there were a few things that contributed to this massive spike that honestly, I don't think any investor has seen before in their entire lives. And these four things are the fundamentals not only to the increases in housing prices, but could also lead to the decline in prices as well. Those four things are demographics, interest rates, inflation, and inventory levels. So first, let's talk about demographics. In April of 2020, it was announced that millennials have overtaken the baby boomers as America's largest generation. Now this is significant because millennials are at peak family formation and home buying age. Even though in 2019 it was said that millennials prefer to rent over buy, unfortunately there are only so many homes that can be rented. And once millennials start having families, they will either choose to rent homes at a much more expensive price, live in apartments, which for a family can be difficult, or start buying homes using an FHA loan where they can have a low down payment. The second fundamental when it comes to the effects on pricing is the interest rates. Over the past couple of years, we saw interest rates near all-time lows, and this increased affordability, which led to increased demand with low supply. Now, since January of last year, we have seen the 30-year mortgage rates double, but because of low interest rates, that played a significant role on these inflated prices. The third element of the massive appreciation we saw over the past couple of years is simply just inflation and the abundance of money that now exists within the US economy. The Fed over the last few years injected trillions of dollars, and this pushed up assets across the board. Now I know that there are several people that would say that this appreciation was a substantial amount, and I would agree. But if we look at the amount of money that was printed, it was roughly the same amount as home appreciation. But with all that being said, I don't want to ignore the fact that we are still dealing with affordability issues, which I'll talk more about later. However, this doesn't ignore the fact that inflation had a huge effect on asset prices. And the last fundamental that contributes to housing price fluctuation is inventory levels. Over the last couple of years, we saw substantially low inventory levels, and honestly, these levels were unheard of before the pandemic. But I think we can understand that as inventory levels declined, that made supply go down and therefore led to people paying prices way above listing because there simply wasn't enough housing. But along with inventory, the number of days these homes were on the market was ridiculous as well. In a normal environment, homes average about 30 to 50 days on the market. But in the last couple of years, that number was cut in half as homes averaged about 15 to 18 days on the market. Now, honestly, my wife and I were looking for a home in December of last year, and I could not tell you one house that was on the market for more than 2 weeks. But low inventory played a crucial role in the amount of appreciation we saw over the last couple of years. So these are the four things that help determine price changes in the housing market. But as we look to the future, we need to ask ourselves, are any of these four elements starting to move negatively to where we could see prices decline? When we look at demographics, we will continue to have the largest generation looking for housing. And even though we saw a pause in homes being sold over the last few months, we could start to see demand pick back up and stay high for the foreseeable future. I believe that this could start happening once we see stability in the mortgage rates. And over the past couple of months, we have started to see these rates fall. This doesn't mean interest rates will continue to fall, but I think it's important to consider that we could see that stability happening sooner rather than later. Now, when we look at inflation, the money has already been printed, and there are even talks about new bills coming out that will lead to printing even more money. I don't think that this is going to happen as soon as many people think, but it is something to note. Looking at inflation, we have not seen numbers like this since the 1980s. And even though many people believe that we have hit peak inflation, everyone needs to understand that peak inflation doesn't mean that we have hit the highest prices and we are going to see price drops. What it actually means is that the rate that we are increasing has peaked. So even if we did hit peak inflation, we are still seeing substantial increases in prices in comparison to normal levels. And honestly, it could take us a while to get back to these normal inflation levels. And this is why I believe inflation will be here to stay for a while. Now, I want to touch on some something that I think is important for the housing market in general. As someone who is renting a little less than a year ago, I can say that rents have skyrocketed, and I'm sure many people are feeling that pressure. But as a real estate investor, I can understand why. What we saw over the past few years is that everything that had to do with real estate was increasing, from insurance to any and all repairs. And so in order for real estate investors to not lose crazy amounts of money, we had to increase rents. Trust me when I say that many of us aren't pleased with it, because the only thing that it does for us is make sure that we can pay for it when things do go wrong. I mean, since the pandemic, I've needed to replace a roof, AC unit, and water heater, and all of those things have eaten into any profits that I had. So real estate investors have been severely impacted by the rise in inflation. And even though rents have gone up, know that it's not because we want to profit more off of our tenants. We do it to pay for the people who can stay in our homes so that they can have the things necessary for living. But there is something that is extremely important about the rent increase that I don't think many people have considered. Once again, I just went from being a renter to a homeowner in the past year, and there was actually a major reason for this. The rents were actually higher than the mortgage that I would be paying on a much bigger home. And after finding out that my wife and I were having our first child, we knew that we needed something bigger than an apartment. And what we are seeing right now is a slowdown in home prices as price cuts have increased, but rents have continued to go up. What I could see happening is that rents could move to levels that are unsustainable for people, to where they will actually need to start saving money to buy a house to avoid paying this insane rent. There are options for people to buy homes for 3.5% of the purchase price. And so I could definitely see more people, especially millennials, start to move back to buying homes if rents become too high to maintain. Now, interest rates is something that has been the talk for the last year or so. This has pushed affordability down, which is putting a good amount of downward pressure on the housing market. And something that I will talk about later is that interest rates correlate with affordability. And the problem that I see with many people who believe the housing market is going to crash is that they are comparing affordability of some of the larger cities with massive appreciation and try to use that as a foundation for the entire US housing market. But not every housing market is the same. There are still plenty of areas that have affordable housing. And where I'm currently living, we are still seeing homes fly off the market, because not only are they affordable, but certain kinds of homes have low supply. And speaking of affordability, Black Knight released data that showed the last time affordability was this low was in the mid-1980s, when the 30-year mortgage rate was at 12.9%. Now here is something that I don't think many people realize. When the Fed increases rates, that doesn't specifically mean that mortgage rates are going up. And we have seen this over the past month. Even though the Fed increased rates by 0.75% or 75 basis points, the mortgage rates actually fell 70 basis points from mid-June. Now, I don't think that they're going to continue to fall because there needs to be stability in demand. But this sharp decline in housing demand had to do with affordability declines because of rapid appreciation in certain markets and extreme rate hikes that have fallen back down. The last thing to pay attention to is what inventory is going to look like over the next couple of years. The number of homes on the market in the previous couple of years has been a complete joke, down to a third or half of where they normally are, which increases competition and pricing. Now, what we have seen is that the monthly supply of new homes for sale has hit above average levels. But the problem is that people do not know what is included within this data point. This number includes homes that are for sale that have not even been built yet or have not been completed. And so the real supply for homes is much lower than what is stated here in this graph. What I believe is more appropriate is housing inventory and active listing count. There is only 5 years worth of data, but I think that this is more telling of the kind of inventory we currently have in comparison to pre-pandemic levels. Some markets are experiencing quick corrections in housing, while others are not, and even losing more inventory. And this is why we need to look at the housing market that we are looking to buy or invest in. So when we look at the 4 fundamentals that affect pricing, only interest rates have really impacted the US housing market. We have seen inventory grow, especially in the areas in the western United States like Boise, Las Vegas, Austin, Seattle, and Denver. Although there are a few smaller cities in Florida that are experiencing this as well. But overall, we are still not where we need to be inventory-wise to see drastic declines in housing price. So do I think real estate will crash? When we look nationally, a crash would normally be around 20%. And to say that the entire market will fall on average 20% is really difficult to see, with inflation being high, and millennials will probably start looking to buy homes as interest rates begin to stabilize. And during the Great Recession, guess how far prices dropped nationally? 20%. And many would say that it was real estate that was the major catalyst for the recession. So do you think that the data is really out there to support us seeing housing decline 20%? The current housing environment is very different from the Great Recession in 2008. First, the market inventory is still low in comparison to a regular housing market. Second, which I think is much more important, is that consumers are much healthier today than they were over a decade ago. The financial system is also in a better spot than 2008 because of how many people were getting loans that shouldn't have been. There were people who were buying multiple homes for themselves when they had an extremely low income. And because of the current financial system, the likelihood of people being forced to sell is low, unlike the great financial crisis. So what I'm expecting is that the market will fall 5 to 10% nationally. However, I do see some cities still appreciating, like where I'm at in Georgia. And this is why I want to encourage you to look at your own area to see what is going on in your local market. We need to stop trying to use national numbers to make a statement about local markets because every market is different. For example, I just saw a property across from me that sold in 4 days. So I believe doing your own research could help you either make a great investment because you chose a good market or save you from making a poor investment because the market has low affordability. But I hope you all enjoyed this video, and if you did, smash that like button down below. It helps this channel in a massive way. Also, don't forget to add me on Instagram at JonnyOswald64, where I talk about having the right money mindset when it comes to investing and budgeting. And if you're new here, hit that subscribe button and notification bell. That way you are notified when new content comes out. Hope you all enjoy the rest of your week, and I'll see you in the next one.